You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is none other than Education Wednesday, the day here on the network where we hold court for you out there. Maybe you want to learn a little bit more about these options things. Maybe you've been trading them for a little bit, but you're encountering some rough waters. Maybe you're new to this completely and you want to learn about your first steps to dive into those options waters. Either way, we got you covered here on Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we think so. Let us know if you agree, if you disagree. If you agree, keep rating and reviewing on your platform of choice. It really does help new folks continue to discover the program. If you disagree, send all your hate mail over there to Dan and his team at MTM. They love to get all that stuff. Speaking of sending all your love, of course, I am joined once again by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, as well as the author of one or two or half a dozen options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
Always good to be back, Mark, and you better not be sending me any hate mail, all you people out there. You know what I do with hate mail. I've been known to give people a piece of my mind when I get hate mail. Although I do take constructive criticism well, if you're kind.
Well, I like that. Get the fired up, Dan. Send him some hate mail. See what he sends. As we keep on rolling, it is time to tackle our topic for the day. It is time for some options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
I love it. So festive. Always feels like Flag Day or the 4th of July here on Options Bootcamp. Doesn't matter if it's the depths of winter or the heights of summer, whatever it is, always feels like 4th of July when you listen in to this show. We're going to do a little bit of options drills today. This is where we take an options concept and explain it to you in a little bit more detail, maybe explain how you can utilize it in your portfolio. And today's topic, we've gotten a lot of feedback on this topic over the years and indeed in recent months, as well as new people are continuing to flood in to the options market and into the show. And we had an interesting discussion. We kind of touched on it on our last show, and we said even then, it seemed like this might be a good topic for a full show. So a bunch of you have asked about it, but most recently it was Ben C on our last show. He said debit spreads seem like a bad deal compared to credit spreads. To get the same risk-reward profile, a debit spread requires the underlying price to move, where a credit spread does not. Why would I ever do a debit spread when I can do the synthetically equivalent credit spread and have a higher probability of success? All right, Dan, a lot to unpack there in this topic. We'll get into examples and everything else. But I know on the last show, you even said this topic really resonated with you. You had a lot you wanted to add on it. So let's just start there, kind of your overview. This is a long-running, long-standing debate in the options world, the debit spreads versus credit spreads debate. Where do you fall on this? What are your thoughts on the overall topic? And as Ben puts it, why would you do one versus the other, sir?
Yeah, this is one of my favorite topics to talk about, Mark. And I love what Ben has to say. Like Ben, you obviously have looked into this stuff a lot, and I love that you recognize the synthetic equivalent between debit spread and credit spreads. But let me just kind of talk to that point just a little bit. So let's say the 75-80 put credit spread is synthetically equivalent to the 75-80 call debit spread. Okay. Bull call, bull put in both cases, synthetically equivalent. So in that case, recognizing that they're synthetically equivalent, like that definition means that neither has a higher probability of success. When we talk about debit spreads and credit spreads having different probabilities of success, that only exists when we're talking about using different strike prices, like what is common with debit spreads versus credit spreads, and that negates the whole synthetic equivalent. So, without a visual aid is a little bit tough, but stick with me here. Let's say there's a stock at 85, and you have a bullish bias on it, right? So a typical credit spread that you might trade on a stock that is at 85 is selling the 80 puts and buying the 75 puts. That put credit spread where both options are out of the money. And in that case, you have a statistical probability based on winning. If you want to use delta as a loose rule of thumb, you could use 100 minus the delta of that short 80 put to, rule of thumb, estimate your chances of winning. But if you're going to use a call debit spread, you wouldn't use the 75-80 call debit spread. Your risk reward would just simply be pretty much synthetically identical to the put spread we were just talking about. Instead, you would probably use something like the 85-90 call debit spread with the stock at 85, or maybe the 80-90, kind of being below and above the strike. Or maybe if you want to invest less and you're looking for a bigger move, could be like the 90-95. But you would always use both options out of the money on the put credit spread, but you would never use both options in the money on the call debit spread. So I hope that makes sense. It's a really important difference that talks to some of the great points that you made, Ben. But just calls attention to a couple of these really important differences.
Yeah, I like what you did there. I also went and pulled a real world example for some of our listeners out here and looked at an underlying that I know a lot of our audience and a lot of people these days are trading. It used to be a sleepy name, Ford. Now it's lighting up the tape. It's in our top 10 most actives a lot over there at the Options Insider a lot of days. So Ford is trading it up. It's priced right to trade some options on. If you get the underlying, it's around $12. I think at the time I ran this, it was $12.50, almost exactly. It was like $12.47. So made it a good candidate to look at some debits versus credit spreads. Let's of course set the table here with our basic definitions. Again, if you're confused by any of these terms, go back to the archives, go start at episode 1 and really start rolling through. We touch on these topics in a lot more detail in earlier episodes. These are kind of just refreshers here, but still, if you're confused about debit versus credit spreads, start there. The basic definition, of course, your debit means you're taking a debit to your account. You're paying for the spread. So you're typically buying it. You're paying something for it. A credit spread, the opposite. You're typically selling it. You're collecting something. You're getting a credit to your account. So that's the first thing. And a lot of people fixate just on that. Why would I pay something when I could collect something? But as Ben points out, and as Dan pointed out, these are synthetically equivalent, and from a risk profile perspective, equivalent positions. So let's break it down a little bit here. We just pulled a pretty basic example. Ford was at right around $12.50 when we pulled this earlier today here, at $12.47 to be precise. We looked at two basic verticals here. First, the 12 half. I'm violating one of Dan's basic rules here. One of those legs is in the money, but we're going to do it that way anyway because it just lines up nicely. So the 12, you think Ford's right around 12 half. You think it's not going to be much away from the 12 half strike over the course of the next week. We looked at the April 9th expirations. This is going out at about a week and change. Remember, we have a holiday weekend coming up, so a shorter trading week this week. So you're talking about a week and change here on this spread out here in the weeklies. We looked at the 12 half call spread. So that out of the money leg was right pretty much at the money effectively. So you're in the money, at the money call spread here. It was trading for, at the time, looks like you could buy it right now for about 34 cents. If Ford stays at 12 half or above by expiration next week on the 9th, you paid 34 cents. It's a 50-cent spread. So the max it can be worth, listeners, is 50 cents. So you'll make 16 cents on that trade. Of course, if it drops below the 12 handle during the lifespan of that trade, you're out 34 cents. So that's your risk on this trade. You're putting 34 cents to work. That's obviously a debit. You paid money for that call spread. Let's look at the synthetically equivalent other side of that. Let's go. Remember, in that call spread, you were long the 12 strike, short the 12 half strike. Forget about calls and puts for a second. Let's look at strikes. That's the way professionals, the way market makers typically look at it from a net strike perspective. Now we're going to go the same strikes, going to do it a little bit differently now. We're going to go the credit spread example. That same 12 half, 12 put spread. So you're selling now an at the money put, and you're buying a 50-cent out of the money put. You could sell that credit spread right now for about 17 cents. So again, it's a total value if it maxes out at 50 cents. So you're selling it for 17 cents. So your risk on that trade is 33 cents. If the stock drops below the 12 handle by expiration and expires there, you're going to be out 33 cents. If it stays at 12 half and above, which again is your outlook for doing either of these trades, you're going to make that 17 cents. You're going to keep it all in your account. You're not going to lose any of it. So you're looking to make 17 cents. Your risk is 33 cents. So Dan, this is kind of the basic example that I believe Ben is referring to. And this is the conundrum that a lot of our audience comes to. They're looking at this. They're saying, well, they're synthetically equivalent. Why should I shell out 34 cents, Dan, when I could instead collect 17 cents? What do you say to your listeners and to Ben and to your audience over there at MTM when they ask you this same question? Because I know you've gotten it a million times by now.
It's logical, but there's a little bit of a logic fallacy there. Like if we look at debit and credit spreads being synthetic equivalents, the only real, with the same strikes, the only real difference is the timing of the payments. And that's not really that's not really accurate either, because if you can buy the 12 and a half call spread for 34 cents, you're paying 34 cents right up front, but you can lose 16 cents. So just look at it as a binary events. Either you hit maximum win or maximum loss, right? With the debit call spread, you pay 34 cents and later you could just be out 34 cents. It's gone. Or you pay 34 cents and later, you sell it for 50 cents. And so you're taking in 17 cents. So that's timing. Pay now, collect later. With the put credit spread, you have the same risk, 17 cents versus 33 cents. There's a little bit of a tactical, not rounding error, but, tactical thing where it's not precise. But, you collect 17 cents now. And if you win, you get that 17 cents. But if you lose, you pay later 33 cents. So it's just timing. Like the risk and reward, like the amount of money you're paying or getting is still basically identical, but it's just timing. But there's still even yet a fallacy with that one, because if you put on the put credit spread, sure, you're collecting 17 cents, but your broker knows you can lose 33 cents. And so guess what they're going to hold in margin? 33 cents. So you're still effectively paying that money anyway. If you think about it, the money stays in your account, but it's money you can't use. Like you're still paying that. Basically, you're not able to use that money. So I don't know. Like I just don't think it's really a difference at all.
Yeah, a lot of people get really heated about this topic, and many people on our network will say there really is no difference between a debit and a credit spread. You shouldn't use these terms. But these terms are bandied about. They're very frequently used, so we kind of have to address them here on this program. And you're right, Dan. It really is a question of you're paying now or paying later. I could see why a lot of our audience is attracted to the notion of, hey, I would much rather collect 17 cents than pay 34. If it was just strictly in those terms, if that's all it was, if it was one item, someone came to you with a widget and said, hey, would you rather I pay you 17 cents to take the widget, or would you rather pay 34 cents? Of course, you're going to say I'd rather collect 17 cents. But this is not that strict type of environment. As Dan mentioned, there's other factors at play here. You still have that 50-cent spread. So you have that 50 cents worth of risk. In this case, you're collecting 17. So you have the 33 cents of extra risk. And as Dad mentioned, there is no free lunch. Your broker is not an idiot. So they're not going to let you just, here's your 17 cents. Go about your merry way, not take that money and use it in other trades. No, that money is tied up. They'll show you a credit in your account, but you can't just take that money and cash it out and run with it. That's going to be there waiting for expiration. And they're also going to tie up the other portion of that capital, that other 33 cents times however many contracts you did, until you take this trade off or until the trade expires. So the notion that you've collected 17 cents and now you're free to run about your merry way and use it for other trades and things is not the case. You actually have more capital tied up than you think. So by paying the 34 cents, you know exactly what your outlay was already. So you can move on, do other trades. There is no other tie-up involved in that. You put your risk up front. You can go on, do other trades. There's no kind of hidden whammy lurking for you in the background. So I could see on the surface how it's attractive. At the end of the day, risk-wise, there is no difference between these two trades. If you don't understand that, listeners, again, I encourage you, go back to some of our archives. In particular, look up the ones about synthetics. That's where you really need to study it if you don't understand this concept. If you're still confused, just think about net positioning on strikes, right? If you buy the 12-half-12 call spread in forward, you're long the 12 strike, you short the 12-half strike. If you sell the 12-half-12 put spread in forward, you're short the 12-half strike and you're long the 12 strike. Just think of it that way. That'll make it a little bit easier for you to wrap your head around the risk equivalency that is going on here. And it's a question of, do you want to have a little bit of a credit in your account, but also tie up some other capital that you can't use? Or would you rather just kind of do it all up front, pay it, and then whatever happens, you can go on, do other trades. You don't have to worry about this one in terms of other capital. Your max risk is what you paid up front. You can sleep at night knowing everything you got is on the table there. You don't have to worry about anything else. They're coming and taking something else off your table as well. That's it. So it's really just a preference type thing. I could see how one looks a little bit sexier on the surface, but when you understand what's going on underneath the surface, which is where the rubber meets the road in the options market, you can understand why sometimes, and indeed a lot of times, it's preferable just to do the straight outlay and go on with your life. That way you're not worried about other things, other shoes dropping over the course of the next 10 or so days. And then also, at the end of the day, there really isn't a difference between a credit and a debit spread. At the end of the day, you're kind of doing the same thing. As Dan put it, do you want to pay now or do you want to pay later? Dan, any other thoughts? We could spend hours on this topic. We want to get some of the listeners on too. Any other thoughts here on this heated debate? I'm sure we're going to get deluged with more questions. So this is probably just the beginning of our discussion on this topic. But any other thoughts on this heated, contentious topic, debits versus credit spread, sir?
Well, Mark, the one thing is you mentioned that it is sexier to get payment up front. And as all our listeners know, Mark and I are all about sexy.
That was the original name for the show, wasn't it? The Sexy Camp. And then the censors intervened and they decided, no, Options Boot Camp made more sense. We reluctantly went with that. But, the Sexy Options Show, that was going to be a name as well. We had many derivations therein, listeners, before we settled on Options Bootcamp. But you know what we're not going to settle for? It's your questions, because your questions are always awesome. So let's get to a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, let's get to the mail call. Really quickly before we dive into your questions, I want to make sure all of you have seen. Some of you, many of you actually, are new to the show, new to the network. We've seen a huge influx in listeners over the course of the past year. We didn't do our Broker Madness last year, so you may not be familiar with this, but we've become known in the option space for many things, including every year on March Madness, we do a tournament we call Options Broker Madness. We didn't do it last year for obvious reasons. It seems like in poor taste to do it when the March Madness was canceled and everything was beginning to lock down to have this celebratory type tournament. But now it's back. You guys demanded it. You asked for it. We brought it back. Round one is already in the books. We pitted 16 of the elite options brokers for your enjoyment, edification. Now we're down to the Elite Eight, round two, listeners. We've got some great battles going on right now. We've got the Leviathan, the juggernaut of the option space, Schwab/TD. It's still weird for me to say those both together in the same sentence, but that's where we are now as a result of Merger Mania. Taking on Tastyworks, recently acquired by IG, so they got some capital for them as well. Lightspeed, the little engine that could, taking on Merrill Edge. Merrill Edge, more of kind of the pro user base, but they managed to fight their way out of the first round. By the way, the first round, not a good round for the quote-unquote freebie millennial type options brokers. So Robinhood, they got trounced by Lightspeed. Gatsby, another kind of quote-unquote free millennial-oriented options brokerage, they got trounced by Merrill Edge. I didn't think that was going to happen, but it did. And we've got Fidelity, kind of the oldest of old names in the space, knocking off Webull as well in round one. So for the newer upstart kind of additions to the brokerage space, not a good round one. We also had Ally Invest triumphing over E-Option. We had E-Trade/Morgan Stanley, another one of those merger manias, knocking off Trading Block. I mentioned Fidelity taking out Webull. And TradeStation knocking out IB. I know IB is the choice for a lot of the very active of our audience, certainly on the semi-pro and pro area. So it was interesting to see them getting knocked out very early by a broker that's predominantly known for futures, TradeStation, but they are trying to change that a little bit with a little bit more options action. So how can you participate? The easiest way to do it, head on over to @options. That's our handle on Twitter, listeners. Click on that survey link. It's pinned to the top of our chart, and it doesn't cost anything to participate. You can just vote all these various battles, whether you use these brokers or not. You can go in there and vote. If you don't want to vote in all of them, that's fine. Just vote on whichever ones you feel like. And we've added extra fields so you can give us some feedback on your brokers. Do you like your broker? What do you like most about them? What do you not like? You can check right there if you'd like us to share that feedback on the air or not. We're already getting some fascinating results. And also, if you put your email in there, we could track you, and then we know exactly who is playing, and then you could register to win fabulous prizes. So you put your email in there and you could win fabulous prizes. You already had round one. That's in the books. If you voted in round one, you can come in and vote again. You can't vote more than once per round, but you can vote every round. So get in there @options, make your voice heard. Do you love your broker? Do you hate your broker? Do you want to vent your spleen? This is your chance. Take advantage of our megaphone. Nowhere else in the world does this exist except for our Broker Madness tournament. So if you want to share your love for your broker, or you really want to crap on your broker or another one, take advantage. Take advantage. And you can win fabulous prizes to boot. Everyone wins. It's a win-win. @options is probably the easiest place to make your voice heard. Click on the link. Get off to the races. All right, Dan, speaking of off to the races, your MTM community is off to the races. They're hitting you up with questions left, right, and center. What is on top of their brain this week, sir?
Well, someone asked me earlier this week if we use PE ratios when it comes to options trading. And man, that's a really great question, I thought. And the answer is maybe. PE ratios tend to be more for investors. They tend to be for more long-term plays, because if the PE ratio is whatever it is, that is not going to affect the price of the stock over the next week, unless perhaps earnings comes out over the next week. Then it may have some effect. But that's a longer term thing. So that being said, there's two things. Let's start with people who use options to invest. If options are part of your long-term investing strategy, like they are sometimes with covered calls or cash secured puts or diagonals, that could come into play because PE ratios are one factor that help long-term investors decide on whether or not it makes sense to buy a stock or if it's too expensive relative to where earnings have been in the past. Shorter term traders, not investors, but traders, it doesn't come into play at that much. The only way where I think it comes into play and maybe accounts for about 1% of my decision making is if I'm studying a chart or have some otherwise reason for getting long or short a stock with an option strategy over the next week or so. If it has a good value, and I think fundamentally, whether it's P ratio or anything else, that the stock could go up, that gives me just maybe a little bit of an extra oomph to take a bullish strategy and avoid a bearish one, and vice versa. If it's way over price P ratio, I might hesitate just a little to take that 1 week bullish strategy or be a little more excited about a bear strategy. But that would be an extremely small factor for traders.
Yeah, I'm with you there. I mean, I like PEs. They're useful for your fundamental analysis out there. But for the lion's share of our audience, like you said, Dan, they're slinging weeklies, maybe monthlies. PE is not really going to kick in that time frame. It is useful to help you determine maybe the underlying that you want to trade on. You go out there, say, I want to find an underlying that has X PE, maybe below this level or something like that. That certainly is a useful tool to help filter those out. Once you find your underlyings, though, as Dan mentioned, particularly if you're in the long-term investing, then you have to go out there and choose what strategies are appropriate, what you want to use, and that gets into other things that are completely divorced from the PE analysis. But in terms of helping you select your underlying, certainly useful. If you're out there slinging, as we just put it earlier, the debit and credit spreads in the weeklies, not so much. Let's go on out to our next question here. Let's go to this one. This is a repeat offender here. Dan's comes from Mike Dunlop. He's following up on a question he sent in, looks like a couple of shows back. He says, hi, guys. I wrote you a couple of weeks ago regarding the issues I was having with Rocket changing the strike prices to account for a special dividend. Oh, yes, I recall this one now. He had written a covered call, I believe, in Rocket Mortgages that had this big run-up. And then, of course, there was this special cash distribution that they were talking about. And as a result, OCC changed the strikes. They adjusted the strikes, and he took some understandable umbrage at that. And we told him, as we always do with these types of contract spec questions, OCC is the place to go. So he's following up here. He says, I didn't call the OCC to ask why they did it because at that point it was moot other than for curiosity's sake. It might be informative for down the road, though, Mike and others, to contact them. So they can explain to you exactly what their rationale is. Maybe in the future it wouldn't be as surprising. So that would be useful and just for the edification purposes, if for nothing else. He says, as you recall, my strike for the March 19th was changed from $24 to $22.89. On the Thursday before expiration, I decided to roll the option up and out. So he took it off. Okay, that was a smart move. I bought back the option and sold the April in the weeklies expiring on the 16th, $24.89. Same strikes are terrible. These $24.89 call and collected an additional 89 cents in premium. This allowed me to keep my stock, collect the dividend, and collect a little cash. For information's sake, Rocket closed on strike day at just over $23, meaning my original 24 option that I sold was the perfect strike price for my covered call selling plan. However, after the change, my option would have been just barely in the money. So yeah, you would have lost your stock there, Mike. Well, he has another part of his question. We'll get to that in a second. But Dan, what are your thoughts here? And it sounds like he took some of our suggestions. I think we said if you didn't like it, take it off and roll it again. He didn't take our suggestion on contacting OCC. But when this kind of thing happens, Dan, what do you think about Mike's response to it, sir, by rolling up and out and still keeping his stock and getting a little extra premium to boot?
You know what, Mike? I actually have a covered call on in Rocket also. I was right there with you, experiencing the same thing, and that's what Mark just said is exactly what I did. I did roll up and out. I don't know if it's underwater anymore at all, even because you also have to consider the what was it? Was it $110 or $55? I forget what it was. $110 that per share. I forget if it's $110 or $55 per share, but you're getting extra, you're getting that dividend also because it was a special dividend. So you've got to kind of P&L that into it. So yeah, I mean, my plan is, these calls that I'm short are going to expire in not too long. And once they do, I'll roll again. And if I get called away, it's okay. I mean, I originally put these on selling a super high strike so that I could participate in the pop, but it's taken a lot longer than I expected, and it may never happen. So if I get called away and only make, a couple $100, call it 10% in a month period, I'm not going to cry. But as it keeps staying here, or if it goes higher and implied volatility rises with it, which I expect it would do, I'm just going to keep rolling up and out. And I still feel like it's a great play.
Oh, you guys are all talking me into covered calls and Rocket now. I'll have to check them out after the show here. But let's keep on rolling. He has a second part, an addendum to his question, Dan. I usually allow you only to have one, but his first question was pretty good, so we'll let him have a second. He says, I was listening to your talk on mini options, and it occurs to me that most of the issues with the minis could be resolved if they just got rid of the regulars when a mini is created. Oh, that's interesting. He says, for example, a 1/10 mini option of Amazon with 10 shares would trade perfectly fine if you didn't have people able to continue trading the 100 share options. They couldn't hose everyone on the commission. I'm guessing he's Canadian. Hose. He couldn't hose everyone on the commission, and there wouldn't be any slippage issues because everyone would be trading the same options. The pros, funds, and rich could still trade 10 contracts for their 100 shares. Problem solved. Thanks for answering on Options Bootcamp. Yeah, I don't know about this one. I like the notion of bringing back minis. We had a big discussion about it. Check it out if you missed it, listeners, a few episodes back. I think they make perfect sense right now. Getting rid of the regulars in favor of the minis, though, not having them both trade simultaneously, I think you might encounter a few issues with it. Dan, what are your thoughts on Mike's proposed solution? Bring back the minis and then get rid of the regulars.
Well, the thing about getting rid of the regulars is like, look, Amazon is what is a $3,100 stock right now. But what if the exchanges got rid of the regulars, went to 10 shares for the settlement, and then tomorrow Amazon does like a 20-for-1 split? Then it's a gigantic cluster. Cluster. So I don't think you want to do that. And plus, people use options to hedge round lots of 100 shares typically. But let me address the other part of the question, because I think that's really relevant. When you add another choice solution to trade options on something, like if Amazon went to like 3 times a week or went to adding also minis, it doesn't split your liquidity. It doesn't divide up your liquidity. It increases your liquidity because these are like kind of somewhat fungible among each other. And so you have people who are doing arbitrage and saying, oh, well, if the 10 times ones are trading at, or if the 10 share ones are trading at 40 cents, but the 100 share ones are trading at $5, there's a misprice because the 10 share ones should be trading at 50 cents if that's the case. So there's arbitrage. So I'm going to buy the 10 of the 10 share ones at 40 cents, sell one of the 100 share ones at $5, and I'm basically locking in $1. So you end up getting more volume and therefore more liquidity. The only issue, and this is one of the big things that I think really screwed it up last time, is I think the brokers didn't really buy in and come up with a solution for commissions. And I don't have a great answer for that. The exchanges and the brokerage firms would have to work something out that makes sense and is a win-win for the exchanges, for the brokers, and for you. But that's the one piece of the puzzle that would need to be solved to make it work.
Well said, sir. We love all your questions and your suggestions. Yeah, I'm not exactly on board with this suggestion either here, Mike, for a lot of the reasons Dan just laid out. I could see why you might think this would be good, because one of the issues they did encounter in the early days of minis was confusion. People were confused about which ones they were actually trading. How could they find the minis? The brokers didn't do a great job of surfacing them. So there was some confusion, which this would eliminate. But as Dan laid out, it would cause a whole bunch of other problems. For example, right now, Amazon's trading an ADV of about 260,000 contracts. So clearly there's a use case for a lot of people out there to trade Amazon standard options. You don't want to just get rid of that. And then B, the standard options are what the market makers are leaning on to make the mini options, which, let's face it, they're going to trade less volume at first. They need to be able to hedge it with something else. So the standard options are what they need to have to lean on. So you get rid of a standard option. Now you just got this relatively illiquid mini you're listing. It was going to cause issues, least of which if there's a split or anything else. So there's a robust market right now for Amazon options. You don't want to dilute that or mess that up. You want to be additive to it. So I agree. There could be a little bit of confusion there, but you need the other options to be able to provide a deep and liquid market for the minis. Otherwise, these minis are going to be crazy wide. We have the same problem we had back in the day. So hopefully all your feedback about minis, maybe we'll start seeing some talk about this from the exchanges and OCC in the near future. I got a feeling this is going to be something we're going to be talking about again. This is good stuff. But unfortunately, listeners, that music needs to come up against it for this episode. Great questions, great comments. As usual, we'll get to more of them on our next episode. Remember, get out there and vote. And our Options Broker Madness at Options is the place to go to make it. Let's pin right to the profile. You can't miss it. So good stuff there. And Dan, speaking of good stuff, what good stuff is cooking in the land of MTM these days, sir?
Oh, Mark, we are bringing our options retreat, our legendary options training retreat, online this year, and it's finally available, and we actually have an early bird special on it, like ridiculous prices. And that is at markettaker.com/summit. You should totally go and check that out. It's amazingly great. All the planning that's going into it is going to make it our best event ever. So far we've got more people registered than we've ever had. So go to markettaker.com/summit and join. It's a 3-day event, June 3rd, 4th, and 5th, that really transforms your trading. And it's a really wonderful networking opportunity, great way to meet fellow traders. And, oh man, you're going to love it.
I've been trying to scam a ticket to this thing for years, listeners. He had the wine train, all kinds of cool events, and Dan would never comp me a ticket, listeners. So get your chance, get in there, and check it out for yourselves this year. Market Taker, 2 T's. Don't forget the second T.com/summit. On behalf of Dan and our friends over there at Demand Derivatives, check them out, demandderivatives.com. Click on the crowdfunding tab to begin your adventure out there. Small minimums you want to play in the fintech investing. Maybe you get a piece of a volatility exchange that's coming to a market near you. Demandderivatives.com is the place to go. And of course, on behalf of myself, I want to thank everyone out there for downloading, streaming, subscribing, for keeping those awesome questions coming in. We'd love to hear from all of you. Later today, if you're listening, you're going to hear a little bit of OPR hitting you there for the second half of Education Tuesday. Back again tomorrow for episode 2 of the bi-weekly extravaganza known as the Option Block, as well as This Week in Futures Options. Friday, 1 p.m., I should say noon Central, 1 p.m. Eastern for volatility views. Back again on Monday for the Option Block and the Crypto Rundown. Interview Tuesday, all the way back to another Education Wednesday, another episode of Options Bootcamp.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.